The United States stock market has always been a global financial compass. What happens on Wall Street rarely stays on Wall Street. As we move into 2025, investors around the world are asking the same question. Is the U.S. stock market heading toward a new boom or preparing for a major correction? After years marked by inflation shocks, aggressive interest rate hikes, artificial intelligence breakthroughs, and geopolitical uncertainty, 2025 stands at a critical crossroads. In this video, we will explore the macroeconomic backdrop of the U.S. market in 2025, the role of the Federal Reserve and interest rates, key sectors shaping the market's future, risks investors cannot ignore, and finally, realistic scenarios for where the U.S. stock market may go next. Let's begin. The economic backdrop of 2025, the foundation of any stock market outlook, starts with the economy. By 2025, the U.S. economy is expected to operate in a post-inflation normalization phase. Inflation, which dominated headlines earlier in the decade, has gradually cooled but remains structurally higher than the ultra-low levels of the 2010s. Economic growth is likely to be moderate rather than explosive. Key characteristics of the 2025 U.S. economy: slower but stable GDP growth, a labor market that remains resilient, yet less overheated, consumer spending under pressure from high living costs, corporate margins facing long-term structural challenges. This environment creates opportunities, but also limits how fast stock prices can rise. The Federal Reserve and interest rates. No institution influences the U.S. stock market more than the Federal Reserve. By 2025, markets expect the Fed to be in a rate stabilization or gradual easing cycle. However, this does not mean a return to near-zero interest rates. Instead, the new reality is higher for longer interest rates, a tighter liquidity environment, less speculative excess compared to previous bull markets for investors. This changes everything. Cheap money fueled massive rallies in tech and growth stocks in the past. In 2025, companies must justify their valuations through real earnings, cash flow, and efficiency. Corporate earnings, the true market driver. While headlines focus on interest rates, stock prices ultimately follow earnings. In 2025, U.S. companies face a mixed earnings environment. Strong companies with pricing power continue to perform well. Weak business models struggle to survive. Cost-cutting and automation become top priorities. Artificial intelligence, productivity software, and automation tools allow corporations to increase output while controlling labor costs. This leads to a wider performance gap between high-quality firms and speculative names. The role of artificial intelligence. Artificial intelligence is not a trend, it is a structural transformation. By 2025, AI is deeply embedded in finance, healthcare, manufacturing, and marketing. Productivity gains reshape corporate strategies. Data becomes the most valuable asset. However, investor expectations must be realistic. Not every AI-related company will succeed. Valuations matter more than narratives. The AI revolution creates long-term winners, short-term bubbles, and intense competition. Smart investors focus on companies that monetize AI, not just talk about it. Key sectors to watch in 2025. Technology remains dominant, but leadership changes. Mega-cap tech companies focus on efficiency, AI integration, and shareholder returns rather than hypergrowth. Energy. Traditional energy benefits from global demand stability, while renewable energy faces profitability pressure. The energy transition continues, but not without volatility. Healthcare, an aging population. Biotechnology innovation and AI-driven diagnostics make healthcare a defensive yet innovative sector. Financials. Banks and financial institutions benefit from higher interest margins, but face credit risk and regulatory scrutiny. Consumer sector. Consumers are more selective. Luxury and essential brands perform better than discretionary spending-heavy businesses. Geopolitical and global risks. The U.S. market does not operate in isolation. In 2025, key risks include ongoing geopolitical tensions, supply chain reconfiguration, trade policy uncertainty. Political polarization in the U.S. elections, wars, and global alliances influence investor confidence. Markets may experience short-term volatility, even if long-term fundamentals remain intact. Market valuations, overvalued or justified. One of the biggest debates in 2025 is valuation. Some segments of the U.S. market appear expensive. Others are reasonably priced or even undervalued. Key valuation drivers: interest rates, earnings growth, productivity improvements, capital efficiency. Rather than asking if the entire market is overvalued, investors should ask which companies deserve their valuation and which do not. Investor psychology in 2025. Psychology plays a powerful role in market cycles. By 2025, investors are more cautious than during previous bull markets. Retail participation remains high, but more informed. Fear and greed continue to drive short-term movements. Social media and financial influencers amplify emotions, making discipline more important than ever. Possible market scenarios for 2025. Scenario 1. Soft landing and steady growth. Inflation remains under control. The Fed gradually eases. Stocks rise moderately with low volatility. Scenario 2. Volatile sideways market. Earnings grow slowly. Rates stay high. Markets move sideways with sharp corrections. Scenario 3. Downside shock, unexpected inflation resurgence, or geopolitical crisis. Rapid market correction. Flight to safety assets. The most realistic outcome lies between Scenario 1 and 2. What this means for investors 2025 is not about chasing hype. It is about risk management, quality over quantity, and long-term thinking, diversification. Patience and discipline outperform speculation. The era of easy money is over, but opportunity remains for those who adapt. The U.S. stock market in 2025 reflects a world in transition. Growth is slower. Money is more expensive. Innovation is accelerating. This is not the end of opportunity. It is a shift in how opportunity is created. For investors who understand the new rules, 2025 can still be a year of strong, sustainable returns. The question is not whether to invest, but how wisely.